All right, welcome back to Wook Capital Management's 42nd,
41st
41st weekly Wook in Review. Managing Director Rod Alsman. I am going to make everyone aware that Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from a professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. So with that mouthful out of the way, happy Friday, everyone. Thanks for joining us. Joe has pinned the thread for today's prepared portion of the discussion that we'll walk through before opening the floor up more broadly. So, sorry, I'm trying to manage, it feels like 10 screens. Okay, there we go. Just trying to open up the newsletter. So again, if you're joining this for the first time, I'm sharing my screen in the Wook Discord server in the voice chat. If you want to follow along with visuals as well as audio, feel free to tune in both. Obviously, if you're watching this on replay, you'll have both. But if you're audio only, that's okay too. I'll do my best to voice over what we're looking at, and it should also be somewhat in that thread. Okay, we had a slew of news this week, a lot of macroeconomic data that is largely positive. We've got a lot of regulatory related items to kind of talk about this week. So I guess just markets wise, kind of what happened this week in markets, all of the major indices up substantially. Small caps and NASDAQ up a little shy of 4%, S&P up a bit, about 2.5%. We got kind of favorable inflation related news. So yields, especially kind of shorter dated, the 2-year yield has come down the 10-year has come in about 20 or so basis points from last week. So broadly, yields have come down somewhat as the market has digested the new information from this week's CPI. Sorry, I have a ton of articles open. I'm trying to walk through. So, okay. Book club, that'll be in 2 Tuesdays from now. We'll go over Howard Marks' Mastering the Market Cycle. It was fitting that Mr. Marks put out a memo just last week, kind of highlighting some of his best hits, if you will, and just talking about kind of how infrequently he himself makes calls on markets, and he has done it a handful of times over his 5 or so decades in markets. So I think that'll be a good discussion. All right, so let's start with the crypto stuff. There was a court case that was resolved. There was a ruling in the Southern District of New York somewhat in favor of Ripple, which is one of the early companies in the whole cryptoverse. The ruling was kind of split, basically that it's actually, to me, it's a horrific ruling. I think it's actually going to be hugely detrimental to the layperson, the typical consumer, if it stands up. I don't think it stands up on appeal. There was so it's funny, Matt Levin always, it seems like every day he says, I'm going to be off. Then there's some big news that comes out that he ends up putting out an article anyway and having to write about. So he wrote a bit about the Ripple situation in his newsletter, his money stuff write-up, which I have on my screen if you haven't read it. Again, I think it's a worthwhile subscription. You're going to get it for free. But kind of the nuts and bolts of it is that we got a resolution where Ripple's sales to institutional buyers were determined to be sales of securities and were thus not permissible in the manner in which they did it. But the judge somehow was finding that sales of Ripple to people who weren't sure they were buying it from Ripple are not securities. I mean, look, it sent Coinbase to the moon yesterday because the risk for Coinbase is that they have all of these things on their platform that SEC has alleged are securities, and this judge has now said effectively it's okay for SEC, and not for SEC, for Coinbase to have all of these things up on its platform because under this judge's strange interpretation, they're not securities if they're bought by someone who doesn't know who they're buying it from. It's really bizarre, actually. So his assumption, and I think the outcomes from here are, he says, I assume the SEC will appeal, which of course they will appeal. And then there's three possibilities he sees from here. First one is that Judge Torres is wrong, which is what I believe, and that an investment contract is based on its original substance, even if it later trades in the secondary market. His example that he shares is if Meta sells me a share of stock and I sell it to you, it's still a security. Just because Ripple sold XRP to institutional investors, just because those institutional investors sell it to me or you or somebody else, it's still a security. It can't go from being a security to not being a security. It doesn't really pass the smell test. But okay, whatever. Maybe that the SEC won't win on appeal. But one thing he says is, quote, the theory here is much stranger. It's that each individual token sale is a securities offering if the investors are sophisticated and not if they are not, which is just completely bizarro. Because if you think about what does that lead to? If this were to be upheld, it basically means there's no consumer protection for the unsophisticated, the people that are going to be victims of all the scams and frauds in this space. But the sophisticated investors, it will be a regulated securities offering for the institutional buyers. So it's just a really bizarre ruling. I saw a few analyst reports out today kind of saying that the rally in Coinbase is just silly. It's unfortunate for me. I noted on my personal Twitter account that I'd written a $90 call on Coinbase last week for $5 in premium. So, unfortunately, that position's underwater. I did write another call yesterday, a bit farther out. So let's see what happens with Coin. Okay, the second potential, outcome from the SEC's likely appeal would be that Judge Torres is right in her investment contract analysis, but that the traditional test, the Howey test, is not the right way to think about crypto, and that the right way to think about crypto tokens is not to use the historical test for securities, but by saying, well, how does it work with stock, and reasoning by analogy, which is, in his view, the right intuition, but it's not the law. And unless the law were to change, I think he's a bit skeptical that that's the outcome. And then, of course, the last option would be that Judge Torres is right, the SEC is wrong. Crypto tokens are not securities unless sold to sophisticated investors like venture capitalists in a fundraising round. So obviously, that last outcome is what I think a lot of market participants seem to have reacted like yesterday, bidding up a lot of shit coins, bidding up Coinbase and other related parties. Nvidia had a really good day yesterday. I think you could read through to that perhaps there will be more crypto demand because of this ruling. Tesla also was up because, Tesla. He ends it just. I'll welcome if anyone who's listening wants to chime in on this crypto discussion. Please feel free to request to speak before we move on to the next topic. But it's kind of interesting, the way he ends the statement. I'll read off In the 1920s, a lot of people started very shady companies and raised a lot of money by selling stock with bad and misleading disclosures. And so the securities laws were created to stop them. Okay, seems reasonable. That did not have the result of stamping out stock issuance in the US. Quite the contrary. The US stock market was helped enormously by having disclosure rules and protections for retail investors. The basic rule of the US stock market is, quote, you can kind of do what you like with sophisticated investors, but there are strict rules about how much you have to disclose to retail investors. And that works out well. The opposite rule in this case. You can do what you like with retail, but stay away from sophisticated investors. Seems to likely work out poorly. If the law encourages crypto companies to take advantage of the least sophisticated investors, then who would want to invest in crypto? So it really is a bizarre ruling to me. Clearly, other people feel somewhat similarly. We won't, of course, have a full resolution until appeal is exhausted. But yeah, at the end of the day, Congress, if this were to be resolved and it were to be upheld, I really think Congress would need to act to protect consumers from all of the fraud that's being perpetuated against them. So, we'll see where it resolves. Obviously, I'm quite skeptical that this is a good outcome for the lay people. But if you're a shitcoin trader, it's a fantastic outcome. And if you are long Coinbase calls, it is a fantastic outcome. So yeah, I'll pause there. Joe, I know we have differing opinions on crypto.
No,
But
I mean, like, this is outrageous. Like, anyone can agree with that. The fact that how sophisticated you are determines, like, how protected you are
right.
is insane. I would love to know the depth of this judge's understanding of crypto and, like, why he was qualified to make the decision in this case.
Yeah, I don't know. Just one other kind of story I had up on it, talking about a couple analysts. I'll read off a couple analyst quotes. Um, so Berenberg analysts wrote in a note, quote, despite investor fervor, the rally in response to this development was, quote, was not warranted, and the analysts urged investors to take a close reading of the ruling. Those analysts argue the courts did not outright agree with the notion that cryptocurrencies are not securities, and thus the transactions are not in violation of federal law. So, I'm not a lawyer. We'll see what the next step in this case is, but it's obviously bad for SEC in terms of, if this were to be held up, then as the Canaccord analyst notes, then Thursday's ruling helped, quote, tip the scale even more toward a favorable outcome for Coinbase, who says that the exchange has, quote, a good chance of securing a legal victory and vindication for the company. Obviously, Bitcoin spiked a lot yesterday. It gave back a lot of that today. It was down. It is down about 4% right now. But again, Bitcoin's still trading at $30,000 for Magic Internet Beans. So yeah, still up a lot from where it was a month ago, up almost 10%. So we'll see what happens with this one. Obviously, this is just this is a ruling, but it's likely going to be appealed. But in the meantime, the rally marches on for crypto. All right, I'll keep moving though. If not seeing anyone pressed in to come up and ask questions on that matter, we can always circle back to it when I get done with the prepared content. So the next item that we have in the newsletter today, which again, if you are not signed up, you can click the little newspaper.wook.gg in the Wook at Wook Capital handle. You can receive these every Friday morning. We send them out, and we also post them on the Twitter account in a thread format. But the next item has to do with Activision Blizzard, and we've got a favorable resolution for them finally. So this week, so if you remember a few months ago, it looked like things were derailed because of the UK, and now FTC's request for an injunction has been denied this week. So the US regulators won't be able to stop this. It looks like they are going to attempt to move forward with the transaction. So I'm just trying to find. I had notes on this. Yeah, too many stories. Okay, here it is. So this was in Bloomberg out last night, talking about what's kind of left in the way of this Microsoft acquisition of Activision is in the UK, where they had concerns. It was really bizarre because the UK's concerns were on the grounds of cloud gaming, which is a very tiny sliver of the broader gaming space. So the UK had stood in the way. But what the reporting out of Bloomberg is at this point that Microsoft and Activision are looking to give up some control of that cloud gaming business in the UK as a way to appease those regulators to consummate the deal. They have a July 18th deadline. I know a lot of people have been discussing ATVI stock from a merger arbitrage perspective. So, the stock is still several dollars away from the deal price. So there's still a decent chance priced in that this doesn't close. But you can kind of see if you're looking at my screen, it's been a long march toward consummation of the deal, which this deal got announced. What was it? In January of 2022. So it's been a long, winding process to get this deal across the finish line. But it does look like both companies are of the view that they can close on the deal. They're just looking to kind of resolve this minor constraint of the UK. But obviously, FTC getting denied is helpful for them and has kind of cleared the way for this deal to finally close. And the reporting does kind of note more broadly, less specific to the deal in question, that the deal was seen as a major test of FTC's ability to block big tech deals. So, the loss for FTC is good for other mega caps seeking to conduct M&A. But obviously, under the current administration's nominee, or not nominee, but appointee, you're probably going to get pushed back. We'll see. This is probably the last, not the last lawsuit we see out of this FTC to block M&A. But the ruling, again, from the court was that, quote, the FTC has not shown it is likely to succeed on its assertion that the combined firm will probably pull Call of Duty from Sony PlayStation, or that its ownership of Activision content will substantially lessen in the video game library subscription and cloud gaming markets. So, it's really difficult because it gets back to when you think about competition in markets, you think about video gaming, you think about how Microsoft competes with Sony and Nintendo. And it just, again, you have so many different slices of the video gaming market. Cloud is so inconsequentially small, right? Google Stadia crashed and burned. Sure, over the long run, could cloud take up more share? Absolutely, and it probably will. But console gaming is really what this particular suit is looking at. And console gaming has become a smaller and smaller share of the overall gaming kind of value pool for many years now. I'm pulling up. There's a really good visual. I'm sure you guys have probably seen it. This is a couple years old now, but it shows the kind of breakout of value across the video gaming industry over the last 50 years. So let me move my webcam out of the way. But you can see, arcade gaming, back in the 70s, Pong for any boomers in here, Pac-Man, Space Invaders later in the 70s and early 80s, the OG Nintendo. The console gaming, you can see this green tranche, of the 2020 entirety of the industry, which is estimated at 165 billion. Again, this is slightly aged, just for the purposes of our conversation. I'm kind of pulling it up. You can see the console is only about a fifth of the overall gaming market, and mobile has grown to be more than half, and PC gaming is about a quarter. So it's kind of, to me, like, if you look at a very narrow piece of the market, I can understand the anti-competitive arguments, but when you look at the entirety of the market and you think about video gaming on a broader kind of level, and you can see this very tiny sliver that's cloud gaming. and obviously VR gaming and AR gaming, and that's a question mark of how much that grows in the coming years. Off the back of Vision Pro and other devices, but console gaming has been pretty steady, right? The size of the console gaming space has not been the growth space of gaming. It's all been mobile, really, and I think that I think the UK was kind of wrong in its decision when it looked at cloud gaming, given how tiny it is. But yeah,
Yeah, it just seems like they were trying to nitpick something so they could at least, have their say. I wonder, I'm looking at the visual right now, I wonder where the Switch fits in, right? Like, it's not a
it's
handheld
console.
console, or is it a handheld, I mean, regardless, it doesn't make up any sizable revenue in the grand scheme of things, but still, it's a bit of a handheld, a bit of a console.
Yeah, it rolls up under console, but it is nice to be able to have mobility with it as a Switch owner. Fun fact, I was fortunate enough to buy a used Switch in February 2020 from my local Miami GameStop right before COVID hit. It was very fortuitous timing because if you guys remember, Switches were hard to come across back then after
Oh,
March
yeah.
came along. So it was just coincidental that I had bought a pre-owned Switch in February. Put on many hours of Mario Kart over March and April. And
Yeah, I remember the Switch during COVID was impossible to find. I remember I wanted one because I wanted to play Animal Crossing that was coming out,
yep.
and I'd already owned a Switch previously, but I had sold it 'cause, there wasn't any games out when it first came out. It was a bit of a useless toy. But anyway, new games coming out, I wanted to buy it. So I went on eBay and I just sorted by newest listing. I just kept refreshing until one came up for a good price. I had to refresh for quite some time.
Did you have to pay more than MSRP?
I think I paid MSRP of a new one for a used one, but it
Ah,
came with like 6 games and like 2 extra sets of Joy Cons. So it was
oh,
like
there you go.
it was like worth it to me. And it wasn't used very like heavily. It was
I'm gonna
just came with
probably
some extra stuff.
I'm gonna probably play some video games tonight. Family comes over on Friday nights, and we tend to play
Oh
Mario
yeah,
Kart.
love Mario Kart. Mario Party is my favorite. Gotta get
Yep,
Smash
yep.
Bros. I don't have that, but it's a
It's
good party
funny.
console.
I have I have fond memories of OG Smash and Melee and Brawl. I had never played Ultimate until last week. Was the first time I ever played the newest Smash. So fun times. I know Chris is a fan of Nintendo as an investment, and they as an enterprise have clearly proven with the success of the Super Mario Brothers movie and with their theme parks that there's a case to be made that there's a lot of maybe misvalued or mispriced value in the intellectual property that they have. Right, it's been almost 40 years of Mario now, and it's still just one of those pieces of IP that can sell like hotcakes. I know for a fact I'm going to buy Super Mario RPG, which is a reboot of a game from 2 decades ago, but Nintendo's still going to get my margin dollars, and I'm still willing to pay. And I think broadly consumers um, will. Um, so yeah, any comments on the Activision Microsoft deal? I don't know if anyone is still in the ARB trade or has any thoughts on risks from here, or if they think there's any chance it might not close due to UK. Chris, like to hear your thoughts.
I'm sure Chris knows this, but the CEO of Nintendo's pay is incredibly low. It's been talked about plenty of times. $710,000 fixed salary, and then around $2 million in performance-based compensation. That's nothing compared to everyone else he's up against.
Yeah, I just sold my Activision a couple of days ago, at around 91. I I kind of wanted to just wait and just collect the money, but there's still a little bit of uncertainty. You never know what happens with these things. Um, yeah, Nintendo, like their management, they're very conservative. They're very responsible with capital. They have a lot of cash and no debt. So I think that's really what you want with an investment. You want, people who are good stewards of capital who don't.
No, 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 Chris. You want the shittiest of shitcos in this market.
Yeah.
I jest.
Well, I mean, like if you look at Japan, like these Japanese stocks, who have been very conservative with their cash, got a huge bid this year. I think they're number one this year in terms of global markets. I think they've gone up more than the U.S. has this year. So I don't know if this has to do with some sort of macro stuff, as well, FX stuff, but um, but yeah, I like Nintendo a lot. I've been very vocal about them. I think the valuation, even though has had a nice run this year, I think it's still pretty cheap, in an EV to EBITDA basis. And yeah, I think there's a lot of growth that's not really being priced in here. Maybe I'm wrong, but it seems like the fervor is, still there for Nintendo IP.
So your point about kind of how much of a cash hoard they have is a good one, because you look at on a earnings basis, they don't look cheap necessarily. At
Mhm.
least what you would think of as like traditionally cheap. The forward PE is around 20 as I look at it right now, but that obviously, the price to earnings doesn't consider the fact that uh, let me just pull up the kind of the delta between enterprise value and market cap. So I think that'll, because the market cap is 53 billion US, but in US dollars, the enterprise value is only 34 billion.
Mhm.
So yeah, it looks like they've got almost somewhere between 15 and 20 billion in net cash, which again makes that PE look more rich. But as you noted, if you look at on an EV to EBIT basis, it looks much less expensive. It's around a 10x on that basis, which they've historically been beholden to the console cycle. So I think that's really the question mark, right? Can Nintendo Online, can the new Switch, whatever they end up naming that, which I saw was this week some reporting on just the code name of it and the idea that it's obviously in the works and coming. Um, but can they reduce the kind of boom bust nature of the company that's been very console cycle driven, right? Because the Wii U failed, and that obviously had a very negative effect on the company earlier in the last decade. So, and this next device, could be one of the last pieces of hardware. Who knows, right? Switch is obviously very long in the tooth. We're coming up on the 7th year that it's been in production, so we should expect it, if not next year, then in 25. But keep selling,
Yeah,
right?
Microsoft stated.
They added the OLE.
Well, Microsoft stated the Switch could be coming out the next generation within a year from now. It came out in the Activision case. And they
Yeah,
said they were working on developing a Call of Duty for, let's see the exact word, an in development Switch console.
Chris, I'm looking back on the long-term chart of Nintendo. It's crazy. A decade ago, their enterprise value had gotten almost to zero. The EV had gotten below 2 billion in 2013 on the back of, I guess, the poor Wii U results.
Yeah, those were the days.
What was that? Yeah, that was launched in late 2012. So
Yeah, I think
yeah,
there was a news release a few weeks ago about how the new console, Nintendo said that they want to make it like tied to the Nintendo account, so that basically like all the software would be compatible, um, backwards compatible and stuff, and forwards compatible. Like you wouldn't have to buy a new console to get the new games. Which I think their goal here is to sell more software. I mean, that's where all their margin is coming from. Like
and
as we saw during COVID, it was kind of hard to get these, consoles to people. Um,
And unlike Sony and Microsoft, they don't have the. I mean, they do have the Nintendo Online subscription, but the robustness and also the cost of that compared to Game Pass and PS Plus is just far lower. So, I did see that you just brought up, the idea that they're going to try to make it easier for consumers to shift from Switch to the next gen and retain all of their software. But I would be interested to see, if they end up expanding the Switch Online, or they're able to up the price. I know for me personally, I got an email this week that the price of my Game Pass was going from $15 a month to $17 a month, which, pro tip, if you are a gamer and you do use Game Pass or PS Plus, there's oftentimes some good deals that you can get to kind of lock in several years of preferred pricing. I think I have my Game Pass for a couple bucks a month for like the next 3 or 4 years, prepaid. So definitely that's better than paying them the headline fee on a monthly basis. But yeah, Game Pass, it's obviously kind of the model for Microsoft. It's very different for Nintendo, who's still, like you said, more focused on selling software a la carte. But that it's been tough. Software in 2020 was very disrupted, the development cycle. A lot of games got delayed. I mean, 2023 has had some absolute bangers in the first half. There's some great releases coming in the back half, but did kind of slow the early part of the cycle. And typically when you don't have the software out in the first kind of year or two of the cycle, it kind of negatively impacts it for the entirety of it. And obviously we're not going to see a next generation device from the Sony or Microsoft for a few more years still, given that this holiday will be the fourth, that they've been for sale. So probably another 2 or 3 years until we get PS 6.
I guess more broadly speaking, like, what do you think the implications are of this Activision deal if it goes through, for the broader market environment?
I mean, it's good for mega cap tech if they're going to be able to continue to do what for Microsoft isn't a big deal, right? I mean, what is it, 69 nice $1 billion merger on a company that's valued at, what is it up to now, 2.57 trillion. So I mean, on an absolute dollars, it's a big merger, but in a relative to Microsoft, it's I don't want to call it immaterial, but it's small potatoes. So it is interesting that FTC was stopped from the enforcement, was denied, and I guess broadly you would think then that there's probably less likelihood of successful enforcement action against your other mega caps, under Khan's FTC. So I mean, that's my read through, but I'm not an expert in that space.
Yeah, I have a watch list of a bunch of gaming IP companies, that are public, and day by day, this list is getting smaller as these mergers go through. Most of them are foreign. A bunch of them are in China and Japan, Korea. Not many US listed ones anymore.
That's right. Yeah, mostly Japan, right? I think from a sheer just count basis, probably the plurality of the remaining public gaming companies are in Japan. Does that sound right?
Yeah, by numbers probably, but by market cap, I'm
Not
not
from
sure.
dollars, but yeah. Just talking about the count of companies, yeah.
Yeah, a lot of these are Japanese.
Yeah. All right. Anyone, again, in the audience who wants to chime in on the Activision Microsoft deal, feel free to request to come up and speak. Got 2 more items to get through. 3 more on the prepared remarks, and then we can just open it up for discussion. Not seeing any other requests then. Thanks, Chris, for the input. So we're going to shift gears, but stay oriented in Asia. So we had put a little blurb in here about China. China consumer inflation had flattened out in June. It had been expected to rise slightly month over month, but it was unchanged. So there's been a couple of actions taken by the state to try and provide some stimulus. There was some extension of some outstanding loans to the end of 2024. Those had previously, so that covered a slightly broader tranche of Chinese loans. But one of the analysts, kind of when that report came out, I guess toward the end of last week, had noted that that data argued for more policy easing, which Chinese policymakers were already doing in a measured way. So there's been some incremental stimulus already since then, and just it's still that economy has a lot of youth unemployment. That kind of demand impulse is clearly not that strong there, not nearly as strong as stateside. So one chief economist notes the risk of deflation in China is very real. So we'll probably continue to see incremental stimulus, I think, out of China to try and support the economy there, which is obviously not the trajectory that we're seeing the central bank take here, but it just speaks to kind of and I know, Jiro, you're listening and you're more, I think, tuned in to all the variances between global central banks, but it kind of speaks to how, depending which part of the world you're looking at, the bank, the central banks are on different wavelengths and have different priorities. But again, the impulse in China is stimulus, easing policy, trying to prop up demand and prevent a deflationary bust, I guess, if you will. We can talk more about that one. Let me get through the last two and then just kind of open it up for anyone who'd like to come up and speak. Again, it's about 4:40 Eastern. My plan would be to run it till about 6 Eastern, so we can have a good hour and 15 when I get done with these last two. So the last two items. One, I put this in here because I thought it was just interesting, and we can talk about it if anyone's interested, that Shopify had rolled out this new meeting kind of cost tool on Wednesday with the intention of eliminating unnecessary meetings. So it's a Google Chrome extension. And when employees go to schedule a meeting, the extension estimates how much of their coworkers' time and compensation that meeting will take up. So while there's no repercussions for scheduling expensive meetings, it's just one of those things, I think, to raise the visibility of the opportunity cost of looping a bunch of people in to hold a meeting. How many hundreds or thousands of dollars it could be to host that 30-minute touch base with several managers. And I thought that was just really interesting. It's not something I've seen too much of. I thought it was kind of novel, the idea that they go outright and put a browser extension in. So when you go to schedule a meeting, you will see an explicit estimation of how much it is costing the company. So again, the intention to reduce redundant, unnecessary meetings. That's one way, is to just show the dollar signs in people's face when they go to schedule it. So I don't know how successful it'll be. Perhaps they talk about eliminating 12,000 calendar events from the company having canceled all employee meetings with more than 2 people and all meetings scheduled for Wednesdays. So they're just obviously looking to free up more time. Meetings for the sake of meeting, clearly not value added, and clearly there's a real cost for companies when they're doing just that. So yeah, thought it was an interesting call out. Imanadev, did you want to chime in on that?
Yeah, that's not new. Years ago, when was it? 2000. This is pre-GFC. We had an add-on on Outlook where we used to have this widget that would calculate it and send it to the managers on how much was the cost of the meeting based on imputed cost of internal staff plus actual cost of contractors, right? So basically, once you're in a team, you have, or a project, let's say you have you've cost for every resource, whether internal or external, and we used to run this. And one of the things we found after 6 months was, we called in some of the big consultants and told them to, get the F off meetings, because we were being billed for, I think, 32% or 34% of their entire billing was just meetings. So it was pretty, eye-opening level of detail that we got from that. It was useful for what it's worth, but it can be a little bit gimmicky if used the wrong way, right? If you really want to see, what's the cost of a meeting, and then you start blindly cutting down meetings just because, it turns out to be a lot, then you don't get things done. But if you really start parsing the details of, okay, who are in these meetings, why is it as long as it was, why did everyone there, how did everyone there justify the need to attend meetings, then you start pushing people to change habits, which, at least where I was the expectation. Not so much as to find and cut costs, but change habits of, wasting people's time in meetings. So that's what it was, and I think it served its purpose for having done that. But the biggest surprise was unexpected bonuses of finding, how much consulting, external staffing cost, and what were they doing with their time. And and if they were really only working on things, 2/3 of the time, and 1/3 they were in meetings, what the heck were you paying for?
So eliminating these meetings is a good way to stop paying Bain and McKinsey and BCG so much, is what you're saying.
Well, sort of, because typically the big consultants cost, three, four, five, up to 10 times the imputed cost of internal staff. So, it's far easier to cut, especially if you look at it at a project level. It's far easier to manage your budgets if you don't spend, your $800 resources sitting in meetings, and instead, time it where meetings that these expensive resources are present is only minimal and justifiable, right? Otherwise, I mean, it is eye-opening when you see some of these hour-long meetings with 30 people, and you find that, you know what, 20 of those resources costs $150 an hour, and, five resources cost 600 an hour. you know that was a $8,000 meeting or $9,000 meeting. And, it does raise eyebrows. Well, at least it should start you questioning your sanity on holding these meetings.
I'm sitting here thinking to myself, because I had the opportunity during my time at Ryder on the corporate strategy team to participate in a lot of C-suite strategic planning sessions, and I'm wondering, kind of chuckling to myself, how expensive those were on an hourly basis, having the entire C-suite present in these multi-hour meetings. Oh man.
Yeah, we did. After GFC, I joined Adobe, and fresh from all this data in my head, the first IT strat meeting for planning next year's programs, I went in there and I saw all these, you know, really the leadership of entire IT worldwide of Adobe at these meetings, and I'm sitting there thinking, you know what? This probably blows through, 1 or 2% of the IT budget right there today. And I think I mentioned that to my manager like day or so later, and I was told to, walk away from saying anything. It doesn't sit well when you do it at the highest level, but it goes down very well when you tell the higher level what the lower level is spending on.
Good stuff. All right, let me get through then I'm not going to go over the last item in the newsletter. There were two kind of items I wanted to mention then before we just open it up for floor discussion. One was around labor. So specifically talking about unionized labor. Obviously, there's this risk of a UPS strike in the next couple of weeks. Who knows if they will get to that point? It doesn't look good from what I'm hearing. There was a story out of Bloomberg today talking about how UPS is training non-union employees to help deliver in the event they need them. The other one, obviously, the Screen Actors Guild joining the writers on strike. And then you've got kind of the last headline would be related to Yellow in the less than truckload space. You've got the Teamsters being just completely fed up with Yellow leadership and basically being willing to walk off the job. So there, over the last couple of years, I think with maybe it's just this kind of general comment about this seeming friction between organized labor and their employers. While we didn't get a Southern California ports strike, thankfully, last month it was reported that they are. I don't know that I saw that there was a deal finalized between them, but I saw that there was at least an agreement to work towards it. But just generally, it does seem like there's been more threats of union actions than there have been in recent years, and whether that's byproduct of labor feeling like it's more empowered to take these actions than it has post GFC. Like, if you think about Yellow Roadway, there was both, I think it was in 2009 and also in 2014 that the Teamsters gave in pretty substantially. But it seems like the pendulum, kind of stepping back more broadly, having shifted a bit back toward labor is now taking more maybe aggressive action against employers than it has stateside in the past. And those three were kind of the ones that caught my eye. So I don't know, Mom, Dave, or Chris, or if anyone's listening has thoughts on kind of this interplay between organized labor and employers. Is this just noise? Is this maybe a shift in the balance of power back toward labor? Obviously, we don't yet have a UPS strike, but we certainly do on the film side and on the Hollywood kind of actors side.
Didn't Bloomberg put out a note that the UPS strike could be the most expensive strike in U.S. Economic history or something like that?
I didn't see it. I don't doubt it. I did see that the top 25 e-commerce companies that kind of would be impacted by UPS, which I have up on my screen. I guess it's a little hard to see. I mean, you're big, your Amazon, Apple, eBay, Etsy, Walmart, Samsung. So like, there's going to definitely be some serious disruptions though if there's a UPS strike. They deliver 19 million packages a day, and there's no way that the rival networks could possibly absorb all of the volume. So yeah, it sounds right that it's going to be a very costly strike if they get to it. But the Teamsters definitely, with both Yellow and UPS, do not seem like they are playing anymore.
Yeah, don't forget we had the railroad strikes too. So that was another big one. So yeah, there's certainly been more activist approaches to getting their bargaining done. Not sure. I guess we're just averaging out, like you said. It's been a few years of quiet on this. The bargaining power has been down dramatically. Maybe they're just this is the last stand. I don't know. But what would be interesting is coming in the earnings season. Does it start showing up in guidance and their forward-looking statements that hey, this is coming up, this could upend our numbers or something? I'd be very curious who's going to use that as a as one of their many excuses to justify lowering numbers if they do at all.
Yeah, I can't think that this Screen Actors Guild kind of, not on the UPS side, but on that side, like I can't think that'll be good for, movie theaters, or which are already, have been challenged for a few years now, and are still operating below pre-COVID levels. I'm sure that they'll blame, the strikes, though, to your point, if they can. Sick, I know you're kind of in the industry, and I'll invite you up if you wanted to share any thoughts on kind of what you're hearing and seeing out in LA, in that area, related to the strike. But I mean, I guess that's my takeaway, is that the unions do feel like the pendulum swung back in the direction. A lot of them feel like they've given up, things in the preceding decade or so, and at least on the Teamsters side, it seems like they're over it. And in the case of Yellow, it does look like it may lead to them filing bankruptcy. And I don't know if anyone in the audience has been following the LTL carriers, but your XPO, your Old Dominion Freight Line, your SAIA, SAIA, a lot of these competitive LTLs have run up like crazy. I think somewhat under the expectation that should Yellow fail, they'll be able to onboard a lot of freight into their own networks. But that's a conversation I was having with someone earlier this week, that the LTLs, are they a short? And maybe you wait until the dust settles on this stuff, but a lot of them are trading at record high valuations, and the industrial economy is, monitored. I don't know. LTLs haul more industrial freight more than they do, consumer goods like the truckload carriers do. So you would think that if the LTLs are doing quite well, then that means that the real kind of manufacturing and industrial side of the economy must be doing quite well, or expectations that it will do quite well. So I don't know. That's just one thing I've noticed, is huge run-ups in LTLs that I don't know. It's hard for me to parse. Old Dominion is back within spitting distance of its all-time highs. Excuse me. It's less than 1% off of its all-time high. I think SAIA is at an all-time high again today. Let me double check that one. It's close to the peak of November of 2021. A lot of these companies are back to peak. And I don't know, is it a double top? Not so sure.
I mean, there's no doubt that industrial activity is at a level much higher than it's been in recent times, and there's a lot going on there. There's a lot of money flowing in, and there's a lot of subsidizing of investments going on. But this is interesting, right? So I didn't know about the connection between LTL and industrial loads. That makes sense, because it's sort of indeterminate size almost every time. It could be unique, right? So
Yeah.
that sort of makes sense. And I think about it.
And again, LTL, for those who don't know, less than truckload. So this is a network business. These companies have terminals. They have kind of cross docks, consolidation points. Whereas TL is truckload, it's a full truckload. One person is filling that whole back of the trailer. In less than truckload, it would be many companies' freight is being hauled in the back of one trailer. Just to clarify for anyone who's unfamiliar.
So you know the industry well, Rod. So the question is this the time when the industry consolidates, or does it consolidate more when it's really broken down and things are not working at all? I don't know the industry at all.
LTL's been consolidating for some years now. Knight-Swift, the largest truckload carrier, bought a top 10 LTL carrier AAA Cooper a few years back. The multiples on LTL carriers have been expanding for several years now. And if you think about it, unlike truckload, which doesn't really have any moat, anyone could get their CDL and operate in a lane. For a dry van truckload, obviously, if we're talking about more complicated types of freight, there could be some moat. But LTL, the network effects, getting enough density, there is somewhat of a moat for LTL, and the market's been giving the benefit to the carriers in terms of richer multiples for a few years now. I think this consolidation likely continues on the LTL side. If Yellow fails, I mean, that's just a lot of land, for a top 5 carrier to fail that the other players are going to be able to grab. So it could very well be that the others are kind of front running the expectation that Yellow fails and that they benefit from that. But the other point, and this holds true for a lot of industries, is that their balance sheets have been transformed by COVID. Saya is a prime example of that. So Saya, going into COVID, they had about a turn of leverage, and they have none now. A lot of them have de-risked. A lot of them have gotten a lot of cash flow. I've talked about this in other spaces, that a lot of these carriers, what do they spend their money on? They either are buying new equipment with their operating cash flows, or they're paying out some dividend or buyback. So because of constraints in production, they're still just kind of now getting resolved for the big, the Daimler trucks and the Volvo trucks of the world. Those fleets, that's what they invest their capital in, is new equipment that's more efficient, that their drivers, that's more safe. But a lot of them have just gotten their balance sheets cleaned up, which holds true for a lot of industries. So, but when I look at kind of what you were, you think about it, you're looking at 30 times plus earnings multiples on some of these LTLs, forward earnings multiples, which these are not. I mean, yes, there's some network, so of course you're going to get some operating leverage in these types of businesses, but these are not software companies, and these are relatively low margin businesses. Like even Saya, who's been improving as an operator, their gross margin is, we're talking 26% gross margin, and a lot of these, they go by an operating ratio in this industry. They talk about, we're at 90% operating ratio, so we have a 10% operating margin, similar to kind of how the railroads talk about it. But I guess the way I see it is how can it get better for some of them when they've kind of already gotten priced for perfection? That's kind of the challenge with both LTL broadly and a lot of these super hot sectors is, they've seemingly front run a lot of the future returns, and therefore the risk is now higher.
Well, okay, so let me see if I can try that, take that one on. So if you assume that industrialization is really picking up in the US, and we are deglobalizing, so we have to produce more of our own stuff, which necessarily means that deglobalization makes local hauling much more critical to the to take it from manufacturer to consumer rather than sea freight or anything else. It would stand to reason that this is a multi year long build out for industrialization, given what we are trying to do. And that could also mean that even when you have your customers that are building up for the future and building more capacity, and you have your industry, the weak players getting out of the way, or whatever, for whatever reason the industry is consolidating, doesn't it put the pricing power in the hands of the few that's left when they have more total load to carry over time because it's just more manufacturing locally?
You're right that nearshoring trends are definitely favorable for the incremental need to haul domestically, whether it all goes to LTL or a mix of TL and rail, it's going to vary by where it's located. A lot of it, as you know, is Mexico. There are a lot of existing infrastructure, whether it's road or rail, kind of connecting the two countries. So, yeah, that's a valid point that it could be the market front running the expectation that domestic freight demand is going to rise with a secular tailwind. Jiro, nice to see you. Sick one. I know I asked you earlier about what you're hearing and seeing on the strike side of things. Before I let Jiro chime in, I'd love to give you a chance on that.
Yeah, sorry about that. Like I came in when you mentioned my name, but then like all of a sudden like the conversation jumped to like LTL. I guess like there was like a buffering issue or something. But yeah, like what do you guys want to know about like what's happening with the strikes? The only thing that I could probably say is the studio's probably like planned for this sometime like earlier last year. I'm trying to think of what I'm allowed to say and what I'm not allowed to say. But what happened last December-ish, like I was like hearing through the grapevines that they're already going to be cutting productions for like a lot of the Marvel shows, and when I mean shows, like both TV shows and movies. That also means shifting the timeline for a lot of the movies, like years down the line, like just pushing it out. That also affects budgets. That also affects just like a lot of the productions, as well as like the timelines when their talents can be on these movies or TV shows. On top of that, right now, the SAG-AFTRA strike, which also affects a lot of the marketing folks, like on the tail end, and folks like me. Since a lot of the SAG-AFTRA members cannot be at the premieres anymore, and since they're on picketing, it also affects freelancing PR and marketing folks. And then what I know through the grapevine is between like Disney, Amazon, and a lot of the other studios, a lot of them pushed back a lot of their hiring until like fall. They can't even backfill their the people that they laid off earlier this year. And the companies that are doing well are probably like the reality TV show production show companies or anything reality related. Funny enough, I just got off a phone call with Red Bull, and apparently they did okay even throughout the pandemic versus some of the other I guess like non-reality type shows or creative houses. In terms of like the bottom line is I think there's going to be like just a year-long recession between a lot of the production folks for the next year until the writer strike gets finished. And what we learned from 2008 is the winners that come out of this is more than likely going to be reality show, TV show productions, mainly because they're able to get around the whole WGA and the SAG-AFTRA issues. Because if a lot of the reality show TV members, if I remember correctly, aren't under the SAG-AFTRA because like they're
in line with that, I'm looking at the journal's reporting today, noting that Fox's fall schedule will be mostly unscripted and animated shows. So in line with what you just said, reality.
Except the animated shows might also be affected because like SAG-AFTRA cannot, they're not allowed to do voiceovers. That's also included in the rules. SAG-AFTRA actually released the rule set for like what they're not allowed to do. So pretty much everything in between, from actual being on TV shows, being a background extra, or even like voiceovers, they're not allowed to do it. On top of that, they also put a new rule saying that if there's any prospective prospective actors that want to join the union later down the line, and if they do act during this time, they might be blackballed essentially. So, and yeah, like it's a microcosm also. Like half the time it's not even, so like I'm also in a guild, but I'm in the PGA, and we're actually in support of the writers and the actors. It's just that a lot of both those unions, as well as like the Teamsters and any other unions, are kind of pissed off more at the studios. I think like right now we're kind of seeing like a the cause and effect of the pandemic also. That's my guess also, because a lot of the working conditions was kind of crazy too, kind of similar to the hospitals. A lot of the productions were like, you know, it was really stressful and like really strict. Like everybody in production had to be masked up, and it's still kind of happening just to reduce any sicknesses, because if you pause a production, then the whole production schedule gets pushed out, and it just takes a lot more money to reshoot. But that's kind of a moot point right now, since if the current actors are already walking out on productions that were already written and being produced, then this is worse than the writer's strike. Essentially, is what I'm trying to get at, and it should affect the bottom line of the movie studios also, because like now they got to account for reshoots and extra money spent, as well as pushing out timelines for their movie releases or TV show releases also.
Appreciate all that detail. That's helpful, man.
Can I ask a stupid question? And I apologize, it's probably a stupid question. So, with there's somebody here that I follow. He's not in the room. Tonio, his handle. I don't know him personally, but he is in the creative space, and he talks about how AI is changing, upending his world, and things that used to take hour to do or takes minutes, and I mean, just the multiplier effect of what he can get done in a unit of time is so far greater than what was possible even a year or 2 years ago. So I'm wondering, are things like this coming to head because there is an impending revolution in the creative space, in production, in like all of these automated voice generation AIs? It's like with a few seconds of somebody's voice, you can completely create an AI generated voice of theirs. I mean, I'm just wondering, is this the last stand of sorts before technology completely eliminates or reduces the need for this many people in the field?
And before Sick responds to that, I'll kind of read the quote from the SAG president. Was, quote, "The entire business model has been challenged by streaming digital artificial intelligence. If we don't stand tall right now, we are all going to be in trouble. We are all going to be in jeopardy of being replaced by machines and big business," unquote.
Yeah, so just giving you guys some context, though, I can only say from what I've heard through the grapevine, mainly because my experience is mainly post-production. A lot of my friends that are in SAG and in the WGA, the streaming side kind of messed up their payments in terms of like how they're getting residuals. But the AI thing is, yeah, it's kind of for them an existential issue, because like if AI is able to take over their jobs down the line, you know, there's like two camps. There's a camp that says, "Oh, AI is going to make us completely redundant because like it'll think of ideas and put us on the sidelines, and we're not going to have a job anymore." But there's a small group of folks that believe, the AI portion would supplement writers or help them. But then that's mostly on the TV executive side. But here's what you also got to know. Also, like Hollywood, or like the Hollywood system, is very, very old school still. Like based on like relationships and just creatives and just people working together, versus like using the instead of like the tech industry, where like people are just jumping into like the newest disruptive technologies and to make their lives a lot better. a lot of the Hollywood systems and how it works is very, very old school. It's not funny enough. I'm gonna say like it might be as not that different from like the banking sector, maybe like kind of regulated the way, and then each studio and each union kind of like regulates each other over time. That also being said, yeah, so SAG, one of their key things also that where they mentioned was trying to prevent, like open, where AI generated likenesses of people to prevent that, because like that could be an issue for them down the line also. And then like other companies like when you die, they're still able to generate revenue off your likeness down the line, or to somehow at least protect that. More than likely, a lot of these scanning studios are probably going to do is try to get as many people as they can, or like background actors, before they actually join SAG, and hopefully someone makes it big and keep using their likeness down the line. That's what I'm thinking is going to happen. Before that happens, the guilds are kind of trying to protect themselves as much as possible to keep, I guess, their way of life intact for as long as they can. Yeah, hope that answers your question.
Yeah. I think it's probably a topic that's going to be much talked about in the coming, especially if the reality and the cost of technology in around AI keeps falling. I think this could be a very real existential issue, like you started with. For a lot of different skills and industries and functions. It's obviously at different levels, but I think we're gonna find a lot of things getting upended that we didn't even know was under threat.
Yeah. I don't know, like yeah, this whole thing is just kind of like crazy. Like I never expected like AI to be such a big issue until you would have thought like AI would still be out like 20, 30 years from now, but all of a sudden it's literally at our doorsteps right now, because like the first we're on the fourth iteration of ChatGPT right now, and then it's able to like spit out like, well, not perfect, it can actually spit out stuff randomly at, like with the stuff that's gathered online, and with what was it, like Midjourney making these images, they're pretty crazy. I can literally see a lot of like art directors or like storyboard artists saying, hey, using a 35 millimeter, do a close up of this actor in a sci-fi background with a spaceship and these aliens and maybe a dinosaur and a monkey in the background. Like it would save a lot of like what was it, like previs artists a lot of time, and I think these studios are very, very open to this technology, particularly Disney, because like if you guys know, a lot of the movies that they shoot, they use a crap ton of pre-visualization to storyboard their scripts out before like anything is shot, mainly because they want to know which angles to shoot, as well as to cut down on production time, and it just saves them money overall. That's pretty much the bottom line also.
That's good to know, man. But yeah, thanks for all the industry insights. Rod, remind me one of these days. I'll ask Tonio to join us, and he's very interesting. I don't know if you've seen him around, but he goes to all these AI spaces. He's in a Discord group with me, so I know a little bit more about him, but very little. But yeah, the type of stuff he talks on, how his job has changed. Of course, he's overly enthusiastic about this right now, rightfully so, I guess, because it's changing his job every day. But yeah, the way he explains it, this is a change that has come on so fast and so thoroughly that according to him, it's like far fewer of his kind are needed, the ones that are going to survive are going to be, able to make more, a lot more, but there'll be fewer of them around, because it's just that what he's able to do in a shorter time is generations ahead of what took him days to do just 2-3 years ago. So, I mean, this is interesting, right? So I remember in the Valley 2-3 years ago, the only talk around AI was, we are building all these developmental tools, and we, on the other side, are struggling like heck to hire people. So, let's substitute tools as much as possible for people and enable efficiency of the ones we have to improve. So we don't need that many people anymore. That's the entire extent of discussion. And when you talked about AI, this is what people are mostly talking about: how to fill roles that were difficult to, how to fill mass of roles, so they could concentrate on hiring quality instead of quantity, things like that. And from there to here, we've come in such a short time. It's amazing. I don't know what else to say.
No,
It does kind of make me wonder, because going back to what the SAG president was kind of alluding to, it seems like for labor, a lot of their view is this is our last chance. It's like with how AI, which may not apply for truck drivers, although automated truck driving has been on the horizon for years now. I think it is a sense, it seems like to me at least as an observer, that labor feels, I don't want to say emboldened, I don't know if that's the right word, but maybe it's also desperation. It's like we need to enshrine an agreement that's going to protect us and our jobs for into an uncertain future. So I don't know what the resolution of all these I guess labor issues is going to be. I mean, Giro, you're over in Europe, and like on the there's obviously a lot more organized labor there. Are you like hearing any, I guess, consternation related to AI over there as well?
Oh, well, I mean, first of all, hi there, Rod, and also Monetiv, Chris, Ike, Joe. Uh, a couple of weeks ago, I was actually at a CFA event, and there we discussed AI with respect to the investment industry, right? So it's not representative of a whole economy, but I have to say the sentiment was actually fairly positive, right? So I would say maybe 80% were very positive towards ChatGPT and AI. That it will just get rid of all the tedious tasks, right? And it would free up time for much more productive tasks and much more creative tasks. But of course, in other industries, it will be different, right? So speaking of Europe, because I guess from an American perspective, Europe is all the same, right? But actually, there are very big, how do you say? There are very big differences actually. For instance, like in France or in Italy, it's super difficult to fire an employee, right? And that's also the reason why they also have to think over and over if they really need somebody in the first place, because they know once you hire somebody, it's so difficult to fire somebody that and I think that's also the reason why it's not how do you say, when you compare the COVID period, like in the US, you saw during COVID these 2 months, I don't know, I think unemployment shot up to, what was it, like 16% or something like this, right? And then next month it was already down again at 4%, right? So you don't have these kind of swings actually in Europe. I mean, maybe UK is much more similar to the US, so you would see much more fluctuation in the UK, but France, no chance. Italy, no chance. Germany, maybe a little bit easier. But with respect to AI, uh, I guess in Europe, or how do you say, the average European employee has a little bit more time to adapt compared to in America, because I know in America they can literally get rid of people ASAP, right? I would say in Europe, excluding the UK, people will have much more time to adapt and maybe reskill in whatever direction. Again, at this CFA event, what was also interesting was that one guy quoted Warren Buffett, and he said that, what is it called, like oral I think it's called oral skills, meaning that you are a very good a very good presenter, right? So that this will even become more important, how do you say, like with AI, because AI cannot present it to you in a way as a human can kind of story tell, right? So maybe that kind of direction will have much more value, right? So you will have maybe less of these people, these super smart IT and computer science guys who sit, who sit in the very back of an office, right? But who actually never present, right? I mean, they do all the complex tasks and everything, right? But then the line manager actually presents, right? So maybe these kind of levels will be removed going forward. And actually, it is already happening that because often when you have hiring, when you're firing rounds, then many companies realize that there are a lot of middle managers who actually are not really working a lot. I mean, they are in a lot of meetings, but they are just presenting what their employees did, right? And I think these kind of jobs are at highest risk, I would say, and those technical guys, they would probably need to reskill a little bit with respect to presentation skills, because that will become much more important, because ChatGPT probably also in the next 10 or 20 years, I don't know, will probably still not be able to present like a human, right? And we are still human beings, and everything we actually discuss here, right? All the information we could also Google right now, right? But we also enjoy like having each other's company and that we discuss things, right? So I think this human element will still persist, and it's just we just have to think about like what skills will be valued also 10 or 20 years from now, right? I mean, because all the routine how do you say, like all the routine tasks, of course ChatGPT can do much better because it was trained thousands of times on the same how do you say, on the same task. I mean, in my case, like data science, right, it was trained millions of times how to import data, how to clean the data, how to how do you say it? Like how to do very basic linear regression or multilinear regression and that kind of stuff, right? But everything which is not a frequent task, ChatGPT will also not be able to do. And the problem is also often that now we are thinking, wow, 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 of course, because it can do a lot of stuff that we are doing in our routine jobs. But as soon as this kind of time is freed up, we'll come up with new tasks. But ChatGPT will not be trained on that task yet, right? So humans will always be a step ahead because machine learning works that way, that you need a lot of data to be trained on, and as soon as humans invent new tasks and new routines, it will take a little bit of time until ChatGPT can actually be trained on it and can reliably do also those kind of tasks. So I don't think it's as how do you say? I don't think the world is that sinister actually. Yeah. Maybe with respect to positioning, I wanted to say also something, if that's okay, Ross, or do
Yeah,
you
go
want to
for
say?
it. Again, just before you get started on that,
Yeah, sure.
we obviously went through all of any of the prepared material. At this point, we're just kind of talking about what people want to talk about. So I'm going to keep it going until at least 6 o'clock. And yeah, we'll see where we're at that point. So yeah, please go ahead.
Cool. Sorry. Yeah. Because I missed the first part. Maybe let me just share with the group what we discussed privately before. Yeah. Like, for instance, the divergence between what the equity market is pricing in and what the bond market is pricing in. I mean, it is not very unusual that those markets have a different bias. Let's put it this way. But what is super interesting is that in Q4 2013, the bond market is pricing proper hikes actually already, like in anticipation of a recession, whereas the equity market is actually pricing a huge rebound in earnings and in sales. And this is not how do you say, like, only beating expectations. This is in absolute basis, like proper positive earnings growth and proper positive sales growth. So this is quite odd, of course, because one market is pricing a recession and the other market is pricing how do you say a huge bull market, or actually the equity market already thinks that we are in a bull market. And coming back to this, because what was happening since beginning of the year, so Nasdaq basically since the beginning of the year, like only one way, and S&P maybe, let's say, since October of last year. So I was also discussing that with you guys in our private how do you say in our private setup, but let me also share this with the group, that that if you are an institutional investor, if you are a institutional fund manager, a pension fund, insurance fund, whatever, and you have a benchmark, and those guys are under a lot of pressure now, of course, right? Because probably rightfully so, looking at all the macro data, they were very skeptical of the strength of the US economy, and so they what they usually do is they probably were underweight equities, right? So let's say their benchmark is a 60-40 portfolio, like 60% stocks and 40% bonds, and they can, in their own mandate, they can switch a little bit. They don't need to hold 60% stocks, right? They can go down as much as 45 or 40% stocks, right? So I could imagine, and the data is showing that actually, that at least in the beginning or in the first quarter of this year, that they were pretty underweight equities. So let's imagine instead of 60-40, they were 50-50, right? So they were underweight equities, and they have to explain to clients, okay, why they performed so badly, right? I mean, they have good reasons for that, of course, right? But now, because in order to save their bonus, basically, right? I mean, because now we have already July. It's actually only a couple of months left, right, until the year is over. So we are seeing now, how do you say, like, institutional money and asset manager money going back into equities, right? And I think at the moment they are trying to at least how do you say, they are at least trying to be on par with the benchmark, right? So if the benchmark is 60-40, then they are also trying to be at least 60-40, if not being overweight, right? Because they have a lot of room to cover. So it will be very interesting to see, although they might still be bearish, and although they still just might think, okay, so the recession didn't happen in Q2 as we thought, but we still think it might start in Q3 or Q4, but they will still be forced to be a little bit more overweight, or a little bit, how do you say, or at least at benchmark weight with respect to equities, because they have a lot of catching up to do. So that will be, how do you say, from a flows perspective, I think that will also help with upside pressure on triple Q and on SPX. And then also hedge funds, where I'm seeing now data from last week Friday, where the net position was minus 50%. So they might also go towards maybe a minus 25, or even towards 0% at least, right? So from a flow perspective, I could see further. How do you say? I could see further upside, right? Especially also now with the inflation data coming down. That's also helpful. And what's also again a little bit odd is that bonds and stocks are ripping basically, right? And but this is justified because because bonds because bonds investors are also a little bit more optimistic now, and it's not necessarily that it is because they are buying the 10-year because of recession, but I think many of them are also holding it because if there is a soft landing, then it will also help in a sense because inflation is coming down. So automatically, at least the inflation component of the 10-year yield will also go down, right? So from that perspective, of course, they will not profit as much as in a proper recession, but it would still make sense to hold the 10-year part of the how do you say of the U.S. Treasury curve. So from that perspective, yeah, it looks. It still looks positive, from equity point of view, and I'm happy that I didn't sell triple Q, which I thought I would before earnings season. But let's see. I mean, we still will have, because of base effects, inflation will go up again, and then also, who knows? We never know if there might be something breaking in the next 2 months, right? I mean, who knows, basically. But it's just with the data we have now, it doesn't look so bad, I would say.
I'll add a couple other data points to some of your thoughts, Giro. I saw from Vanda Research earlier this week, they noted that monthly net retail inflows into U.S. equities are at 1.4 billion per day, which is just shy of March 2020's record. I also saw that the Goldman Sachs Prime Desk noted today that short covering is at November 2020 levels. So your point about positioning, hedge funds are still short, but they've clearly been covering a lot of late. It seems like the trend followers are max long, and your point about anybody who's an active manager who has a maybe a benchmark to the Qs or SPY is probably chasing. I mean, it does seem like they've been doing that for a few months now. The NAI, the institutional investor index kind of sentiment looks to be back near prior peaks. And then, of course, fear and greed from that kind of CNN index has been in extreme greed for a bit over a month now. So, I mean, it's the summertime, right? A lot of people are off. Obviously, your European peers are enjoying a many-week vacation. Us silly Americans might have less time. But it seems like it's low volume. The path of least resistance is up. I mean, you're spot on. The economic data has continued to surprise to the upside. So, if it's it's a short-term viewpoint, I could certainly see the things go higher. But I mean, when I step back and look at, again, like if you're trying to make a long-term investment in a lot of stuff, to me, normalized earnings, determining what normalized earnings for a lot of businesses uh, will be, is still really difficult with all the noise the last few years. And as you know, right, the equity risk premium that you as an equity investor are kind of bearing, it just doesn't seem like a great time if you're actually trying to make broad-based long-term investments in large cap companies. But none of that matters. I mean, valuation doesn't matter until it does. But it does feel like a very euphoric kind of market. I mean, I'm sure a lot of people on here might feel differently, but when I just try to observe what people are saying and the interwebs, and I really don't see much bearishness out there. But I think you're right that people have definitely been chasing, and people like to buy things when they're going up.
So there's another step, right? I mean, look, you can have 60 40 70 30 whatever 55 45 allocation. But for people that were allocated well in the stocks earlier, there is also the de-risking part, which is taking profits from some of their positions and and either putting it back to work in bonds, or waiting to see how the earnings play out, and how the FOMC plays out, and how the other central banks follow. So that to me is the part that comes first, right? There is a lot of people that have a lot of profits, and you know I, I fully expect to see in the coming weeks some level of profit taking. Not so much that they've lost faith in the markets, but like me, for example, they're de-risking because the upside risk reward from here on out is far less than it was 2-3 months ago. And most shops, that's the heightened risk is not worth the little extra reward that there is under the conditions that we see here. So I think that not necessarily complete unwind, but rather profit taking, judicious profit taking, is more likely in the coming months than is an outright sell off.
I saw and I see Jiro dropped. I don't know if he got disconnected or if he'll be back, but I had seen a graphic just yesterday that was the S&P 500 price to earnings growth, and it was just extraordinarily high. And I know that there's been compositional changes to the S&P over the last couple decades, but again, like, for this rally to be rational at the end of the day, earnings must grow meaningfully, and the level of what investors are willing to pay for future earnings growth relative to how fast it's growing is just at extraordinary levels broadly across the market indexes, at least. So I just don't. Maybe AI is going to lead to some huge, very imminent earnings booms, and that's what the market is seeing and looking through to. Or maybe it's similar to the late 90s. We'll have to see, I guess, how it plays out. But Monitor, I know you've been monitoring what's come out in corporate earnings, at least this week. Would you be interested in summarizing maybe your thoughts on how the season started off?
Yeah, okay, that might be a good place to start and segue into what we were talking a few seconds earlier. So, at an S&P level, 30 companies have reported to date so far in S&P. This quarter, S&P's earnings is supposed to be around $51 odd, 51.20 or something like that, to be exact. So that is down, a low single-digit percentage from last quarter. And I think for the year, S&P's earnings is just over $200, 201, 202, something like that. So the expectation is, I will put out the exact numbers. The expectation is for a revenue decline of both in single digit percentages of 2-3%, and EPS decline of 6-7%, something like that. So typically about 70% of companies beat on a longer term average. 70% of the companies beat estimates, right? But then estimates are typically well managed, so by the time you go into the earnings season, it's adjusted enough that the expectations match the reality of the situation. So far, of the 30 companies, 24 have come better than expectations. I do not have the exact number on the guides. It's a little bit less on the number of companies guiding up, probably 70%. I have to check that number. I have to back calculate that actually. But next 3 weeks are very big. So next 3 weeks will probably give you the direction of the entire earnings season for most part. By market cap, it's done, but most of the large companies will be out. So it's still the expectation is still an earnings decline in energy, which is the last 2 quarters has been the case, from last year's high, of course, and a small earnings increase in most of the other sectors. I think energy and utilities are supposed to pull back, and the others are supposed to contribute. But remember, overall the earnings is down a little bit. So 30 companies to date so far, 80% of them have beaten estimates, and probably another at least 30, 40 next week. So we should have a slightly better. 6% of S&P is very low, too low to extrapolate anything meaningful out of so far. And they're not really, other than today's companies, they're not really representative of what, in terms of either value, importance, or market cap. They're not really big deal, other than, of course, today's companies. So, but from a industry point of view, most prediction models are showing that discretionary companies in travel sector are the most likely to beat. Delta did.
I
They're
was
all
about to mention Delta. Yep.
yeah, they're also expecting most of the cruise lines to beat. From financials, the G-SIBs are expected to handily beat, but the brokers are expected to disappoint, which I've not read ahead too far. I read that much because that's next week, right? Both Goldman and Morgan, by the model, are expected to surprise negatively, which was, I guess it's not, Goldman's not been on their best game the last few quarters. They have surprised, and they've been taking big charges on their credit card portfolio. Their Apple Card business has been horribly loss making just for them, right? While Apple's getting the best of it, they negotiated themselves into a hole there. So I think they also very recently dumped a lot of their Marcus portfolio on the market at a loss. So it makes sense that and today, from both Citi and JPM, the trading side revenues were down. So and margins and profits were down. So it sort of makes sense that the big broker dealers are probably going to be challenged. The markets themselves, strangely enough, have been getting price target upgrades recently, right? CBOE, I see the exchanges, Nasdaq, they've all got price target upgrades recently. So that's that. Tech is so. I think there is still an unknown. Like I've been saying, I think most models are struggling with whether the revenue from this AI is a year away, 10 years away, 2 quarters away. Nobody knows. I think the narrative has gotten way ahead of reality, in my opinion, at least. So, but Microsoft should be able to clarify that if they are the darling of this AI craze, and if they are able to actually, I mean, look, honestly, I still don't think it's going to show up in the books yet. It's going to show up in guidance at best. So the question is whether they're guiding, whether they have these brave words for next year or next quarter. I guess that's the difference. That's tech. Cybersecurity, apparently the deals are still closing. There has been concern expressed about the deal size, the negotiation time frame, uh, the vendor bloat, which is which the CIOs are fighting back against, trying to get multiple vendors to consolidate, provide a solution rather than them being responsible for that. So in spite of that, the channel checks are apparently showing that cybersecurity spend is healthy. The deals are being signed, so that's that. Industrials. So surprisingly to me, right, industrials have done well in the last 52 weeks. Industrials are the second best performer within S&P sectors, right? The 11 sectors, industrials are number two. They've done I think 22% the last 52 weeks. This year, because aerospace and defense is negative for the year, and aerospace and defense is 27% of industrials. So industrials have struggled. So year to date, industrials are only the fourth best performing sector after technology, communications, and discretionary. But what is interesting to me about industrials is I did a rough calculation since Q1, so the last 3 months, about 55% or so of industrials have gotten price upgrades, price
JP
targets.
Hunt reports next week, and they'll really set the tone. And
There's a lot reporting next week. I
yeah,
think there's GE, there's LMT, there's a bunch coming. So I think there's going to be some real. I mean, fast and all was neither here nor there, but it was close to its all-time high. So it's not down all that much. I don't think as much as it was a slight disappointment. I don't think they're any worse off. WD-40 was actually pretty good. What else? There was another one that ran quite a lot. So that's that in industrials. What else? I like I said, utilities and of course today United Health helped the Dow run up, right? So United Health was positive, but again, I don't know how that changes their real concern about. I haven't read the transcript. I have to. Like few weeks ago, they expressed serious concern about having to approve all these procedures, surgical procedures that had been delayed for years, and they claimed that it was going to hit their bottom line in the quarters to come. And then it runs today. So I don't know. I don't know where the disconnect is there, but yeah, XLV has been weak. AbbVie reported guidance not good. Who else reported a few days ago, a couple of days ago? Obvious a week and a half ago. Somebody reported a couple of days ago again, same thing. Guidance was not good. So pharma is not doing great. Healthcare providers not doing great, which basically means that XLV is dead in the water. Industrials, 2/3 are doing well. 1/3 is sort of going nowhere. Tech, almost all parts of tech are doing well so far, but again, is it priced in? We'll know better, right? The top of semis are probably going to do well because again, they are, if you think about the COVID time, we talk so much about the brought forward revenue from years of from months of lockdown, that all that growth was brought forward. So in some sense, you could say the same thing about Nvidia, is that the next few years of spend that was originally planned a year ago, suddenly companies are cashing those checks right now and spending it, and Nvidia seems to be the only big beneficiary. So the question is, how big is the Nvidia's beat and guide up, and how much likely are the other players losing that business that they could have gotten, or how much of their business is being taken away to fund this Nvidia, GPU buy. So that's tech. What else is there? Again, we talked about airlines fabulously well. I mean, I think we were talking in another space with the folks from Oz. These in materials. Housing. I can't square that with the reality of the interest rates, right? Some of the best performers. We have a company in top 10 that is Pulte is the fourth best year-to-date performance or something like that, or fifth best. There's so many companies that have done 30, 40, 50%, so many industries that have done that kind of return, and among them, right, builders for source. So some of the industries supporting the
Yeah,
building.
XHB is about 40%
Yeah,
year to date.
yeah. So yeah, that's another one. So that one probably is more about guide than about performance. I think the performance part is clear. The question is what they guide. So where does that leave us? Did we miss any sector? Yeah, that's what I have. I have a lot more work to do. I mean, I'm a little bit behind. By now I would have prepared a lot more for the upcoming week, but a little bit behind given the market was so interesting.
Monative, I saw the big move in NVIDIA intraday. Any thoughts on that?
Look, first thing, I didn't catch Nvidia because I thought back in Q4 it was still expensive. It's always been an expensive stock. It's a lesson I never learned. It's one of those things, right? I
No,
never.
I'm glad to know that I'll never learn it too when I get to be
Yeah.
informed the same way.
So I didn't, but I did load up on leveraged SOXL, so which is weighted by Nvidia, obviously. So I did it that way. But look, 7 billion to 11 billion, 54, whatever that percentage is, 55%. Uh, you know, uh, Revenue upside is probably light. They probably do 12, 13 billion and they'll guide up at least for a quarter. What happens post Q4, I don't know, but this is the best of times for them. They are riding, they are controlling the market. They are the only ones with the product. As I heard last week, they are taking orders for shipment in April and May of next year. Confirmed orders. They are only taking confirmed orders. This is for shipment next year at a price that they are setting now before there is any competition in the market. If by any chance Nvidia underwhelms in any way, that's the end of this AI game. It basically means that revenues are not close. That's what it means to me. If there is a chance that happens, I don't think so, at least in Nvidia's case. But if that happens, I don't think anybody is actually making money from AI soon, right? Then this is going to go back to being an interesting story, but not an immediate revenue impacting story. The rest of software, it gets interesting. So when you buy GPUs, you also need a lot of networking gear to hook them together to make it functional. So Broadcom Avago is of course far more down to earth priced. In fact, probably one of the best priced semi, right, at 22, 23 times, something like that. And Hawktan is the kind of guy that does not put up with excesses in spend. He's very tight with money. He will squeeze all the costs out of it that he can, and he buys that kind of business. But he is more about, taking a mature business and making it extremely efficient and lean, that it can keep generating. It's almost like a public PE specific to, software and semis, and he does that very well. They are also the ones making the custom ASICs for Google. Those orders are supposed to be large. I do not I shouldn't talk about Google because my wife works there, and they're under blackout. But I don't have the specifics. Thankfully, I don't want to know. I don't find out. But yeah, that is their big X factor. There could be a large upside for them from that. The VMware deal got approved by EU, so that leaves Britain and China and the US. That probably goes through. So if they start adding those up to their accounts, they'll probably start looking good. And like I said, Hawk10 is very good at speeding up the taking costs out of the equation. So VMware is a mature business already. So he might be able to guide on based on that. He might be able to guide a couple of quarters out what he expects, how much savings he expects from that. So that's a positive for them. Marvell does work for Microsoft, I think, and Amazon, if I'm not mistaken. They are Amazon, sorry, not Microsoft. They are getting orders, but nothing the size of nothing close to the size of what Nvidia is getting right now. So it's going to help them, but nearly not as much as nobody's getting the orders the size of Nvidia. So that's that. Camtech, which is very interesting, that was a few days ago, is a capital equipment maker for the semi. So it's a semi cap, one of the smaller ones. And who was it? One of somebody on Spaces was saying they make about 8 or 10 machines. They sell about 8 or 10 of their machines, big machines, every quarter, or get orders for 8 or 10. They have a good backlog, and they got orders for 42 this quarter. So it looks like from them and AEHR yesterday, which does a lot of systems for SiC foundry, so like Wolf and ST Microsystems, silicon carbide, basically. They also had a beat and a raise, so that does bode well for semi caps. TSM is coming, right? Is next week, if I remember correctly. So that will show the health of the foundries. But from talking to Dylan, just under 30% of the 5.6, 5.7 nanometer is occupied by NVIDIA. A little bit less, a few percentage less, is occupied by Avago, Broadcom. I think AMD has about 15% or 12%, something like that, and they are waiting for the response on their newer product to scale that up. So it remains to be seen how much headroom they have left and how they are able to control prices on their foundries. So that's on the foundry side. Let's see. Yeah, that's all I can think of, Rod. Sorry. That was a big breakdown.
That's a lot of information. It's appreciated. And for those who don't know Monative, I think it's Sunday at 2 p.m. Eastern. Is that right? That you host a kind of a weekly preview, and you'll kind of talk through some of the upcoming earnings?
Yeah, Sunday at 2 Pacific.
Yeah, so be sure to follow Monative's account. He shares a plethora of useful information. Much appreciate you tuning in and participating in our chats. It's I'm gonna take this to wrap us up today, though it's a little after 6 here Eastern. We started this around 4, so we talked through all the content that's kind of in the thread that's pinned, as well as a few other areas. We kind of explored labor and some of these labor actions and what it means. So, Sick One, appreciate your input on the kind of SAG and that side of things, to the extent you're able to share. I think it was a good discussion. Appreciate that. I know that Jiro left, but appreciate hearing what he had to say from the other side of the pond. And yeah, as you noted, it's early on. We're in terms of earnings season. We're going to get a lot more information in the next couple of weeks that should give us a better idea of what companies are expecting to see over the course of this back half, and whether this what has looked to mostly be multiple expansion to date can transform into now some robust earnings growth into the back half of this year and into next year. So yeah, lots to pay attention to. We also do have some programming coming out next week. On Monday, we should be publishing on our YouTube channel an interview with a CEO of a battery recycling company, which I was fortunate enough to participate in a group interview with, as well as we do anticipate that we'll be publishing a single stock research report next week. And I'm looking forward to being on the podcast circuit talking about that in a little more detail. So beyond that, of course, we'll be back next Wednesday night at 7 Eastern with the market open mic that I host on my personal handle at Rod Alsman. We'll be back next Friday at 4 at the market close with our Wook in review that we're having right now. And yeah, look to see some of those. Be sure to follow the Wook Capital handle, and you'll get those notifications. So eager to see next week come about.
Rod, quick question. So Wednesday is a busy as heck day, right? We do have Netflix and Tesla right after. Can you adjust your I love your
Should I move it back a little bit?
A little bit. I'm thinking maybe half hour at least. We don't have to listen to the con call, but at least wait for those two numbers to come out.
Okay. What time is the Tesla release? Is that the later one?
Let me check and DM you, man.
DM me and I'll schedule it a little later then, and I'll put a note out so that we don't have people trying to tune into both. Appreciate that, Monolith. So yeah, look forward to talking to folks next week, and I hope everybody has a nice weekend. Stay safe out there. Talk soon. Cheers, everyone.
Thanks, Rod. Cheers. Have a good weekend, everyone.